Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. We're about to get started. If you have questions or topics you wish to discuss, please chat those over and we'll go through those questions sequentially. The presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. You can find us every day here in our community, mysolo401k.net/mycommunity. For example, you can post forums 24/7. You can join our webinars. We go live twice per day, one time at 10 a.m. Pacific, 1 p.m. Eastern, and then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. It's a great way to learn, to share the knowledge, to ask questions. So for those that are here, thank you so much for taking the time to join. Please chat over questions or topics that you wish to discuss, and then we'll go through those sequentially. All right, so while we're getting letting the questions get teed up, we can start to talk about some topics. For example, we could talk about some of the top use cases that clients will sign up, or customer profiles or customer situations that would prompt someone to sign up with us. So let's go to that section. So why open a solo 401k? Well, the first use case we can talk about is the frugal investor. So setting up our plan will make the self-employed individual eligible to claim $1,500 in solo 401k tax credits. That's $500 per year for 3 consecutive years for a total of $1,500. So those tax credits, keep in mind, it's a tax credit, not a tax deduction. So it's going to be a dollar for dollar reduction in the tax liability. It's not dependent on the cost to set up the solo 401k. So even though our costs are less than $1,500, the individual would still be able to claim all those tax credits. They would just need to set up our plan, or a plan like our plan that includes the automatic contribution feature, which they can opt out of the default contribution amount and still be eligible to claim the credit, and then maintain the plan for 3 years. So for example, if somebody starts up a new plan here in 2025, they're going to be able to start claiming those $500 credits when they file their 2025 tax return next year. Or if someone were to set up, or I should say upgrade, an existing solo 401k, such as a solo 401k at a discount brokerage like Fidelity or Schwab, they would be eligible to start claiming the credits when they file their tax return next year. So those $1,500 in solo 401k tax credits are going to more than cover the cost to set up and maintain our plan for the first 7 years, because our plan fees are $650, which includes the $525 establishment fee, plus the first $125 annual fee. Then starting 12 months later, so for example, January of next year, our $125 annual fee will be due that will cover the second year. So again, the $1,500 in tax credits is going to more than cover our fees for the first 7 years. In addition, for the frugal investor, they will like the fact that they're going to be able to pay our fees with non-retirement funds, because that's going to further allow them to preserve their retirement account balance. Thank you so much for bringing the questions. We'll go to your questions here in a moment. We're just going to go through some more customer scenarios here. So the next customer profile would be the Roth maximizer. So in other words, someone who really wants to maximize the amount of Roth money going into their solo 401k. So our plan is a perfect fit because our plan allows for Roth and mega backdoor Roth contributions all the way up to the overall limit. For 2024, that's $69,000 or $76,500 if you're 50 or older. For 2025, the limits went up to 70,000 or 77,500 if you're 50 or older, plus a super catch-up contribution if you're between the ages of 60 to 63, or instead of the overall limit being 77,500, it's now $81,250. So for somebody that has the self-employment income to justify it, they're going to be able to make Roth and mega backdoor Roth contributions all the way up to those amounts. In addition, for the Roth Maximizer, our plan allows for in-plan Roth rollovers, where this is a situation where someone has pre-tax money that's in a retirement account, such as a former employer plan or a non-Roth IRA, and they roll over those funds to the pre-tax solo 401k account, and then they move the funds from the pre-tax solo 401k account to the Roth solo 401k account. Now, of course, that's going to be taxable for the year of the conversion. It's going to be reportable for the year of the conversion. We handle the required reporting as part of our services for no additional charge. And then going forward, the individual would have all the potential for tax-free growth, because those funds would now be in a Roth account, specifically a Roth solo 401k account. The next customer's profile is going to be the large account holder. So this is someone that has more than $250,000 in value of their solo 401k. Once someone has more than $250,000 in value of their solo 401k, there's going to be an informational tax filing requirement. The name of that informational tax filing form is Form 5500EZ. We handle that Form 5500EZ as an optional free service for our customers. In other words, no additional charge, including filing it under the electronic filing system to make it easy for the customer. The alternative investor will also be highly attracted to our plan, because our plan not only allows for typical brokerage type investments like stocks, bonds, mutual funds, but also true alternative investments, which could include real estate, crypto, notes, private placement, private stock, and precious metals. Finally, the rainy day investor. So with our solo 401k plan, one of the top features that causes clients to want to sign up with our service is the fact that our plan allows for 401k participant loans. So this is where the solo 401k participant is able to take money out of their solo 401k account, can use it for any purpose whatsoever, and it's not going to be subject to taxes. It's not going to be subject to penalties, as long as it's, number one, documented as a loan, and we handle the loan documentation requirements as an optional free service. In other words, no additional charge for our customers, as well as paid back according to the loan terms. So those loan terms are going to require that the loan be paid back in either monthly or quarterly payments, equal payments of principal and interest. The interest is prime plus 1% or a CD rate plus 2%, with the payments spread over a 5-year term. And the amount of the loan is going to be limited to 50% of the balance, not to exceed $50,000. Okay, wonderful. Thank you for letting me lay the foundation there. Now let's go to the questions that are being chatted up. Thank you for taking the time to join, to bring the good questions. Again, you can participate 24/7 in our forums, which you are free to join. All are welcome. You can find it on our community, mysolo401k.net/my community. You can join our daily webinars. We go live twice per day, once at 10 a.m. Pacific, 1 p.m. Eastern, and then again at 1 p.m. Pacific, 4 p.m. Eastern. You can use our solo401k.ai chatbot, which you can find at solo401k.ai. So there's tons of ways to learn, to engage, to share the knowledge, to ask questions, etc. Now, if you're on YouTube, please like, please subscribe. Please don't hesitate to chat over questions, as we've got plenty of time to go through your questions. All right. So if someone makes a contribution to a Roth IRA, does the 5-year rule apply when withdrawing contributions, or does that only apply to distributions? In other words, can you make contributions in 2025 and withdraw contributions in 2026 without penalty? Well, we're talking about solo 401k plans. And so that's a Roth IRA question. So just to be clear, those are two different products, two different rules. Now, when you talk about withdrawing money from a Roth IRA, the rules are different than withdrawing money from a Roth solo 401k. So with the Roth IRA, you look to the ordering rules where you first withdraw the basis or the contributions before you get to the distributions. So in short, yes, the individual doesn't have to wait for the 5 years. They can start taking out the basis or the contributions. And so, yes, if you're talking about a Roth IRA, you could do that. Good question. I'm self-employed. I contributed to a 401k and max it out, 23,000 for 2024. I'd like to know if I can contribute more to retirement by contributing to a SEP. I'd like to know what I'd need to have in place to reach the $69,000 limit. So, as a matter of fact, most individuals, and we're going to be talking about SEP IRAs versus solo 401ks tomorrow. So please please subscribe to get the notifications. But as a matter of fact, there's in virtually all scenarios, someone would prefer a solo 401k over a SEP IRA. Specifically, one of the reasons is contributions. So when you talk about making contributions to SEP IRA, you're going to be limited to the employer contribution limit. And if you make contributions to a SEP IRA, those count against the contributions that you can make to the solo 401k. In other words, they're aggregated. So there's no benefit in making contributions to both. But with the solo 401k, you're not going to be just limited to those employer contributions. You're also going to be able to make employee contributions. But even if you've maxed out, say, contributions to a day job plan, like it sounds like you might have in this case, and then you're separately self-employed, you're also going to be able to make what are called voluntary after-tax contributions. So the employer contribution limit is a percentage of your self-employment compensation, right? Let's assume that you're self-employed as an S corp. So you got a W-2 job, you max out contributions to your day job 401k, but then you also have a separate side business that you operate through an S corp. And your ability to contribute to the solo 401k for a self-employed business sponsored by an S corp is based on the W-2 wages from that S corp. So in that case, the employer contribution limit that could be contributed to the SEP or to the solo is the same. It's 25% of the W-2 wages. So if you wanted to contribute $69,000 as a SEP IRA contribution, you'd have to have 4 times that amount as self-employment income to justify that contribution. But with our solo 401k plan, you're of course going to be able to make the employer contribution. And again, it's the same limit. But you're also going to be able to make voluntary after-tax contributions. So the voluntary after-tax contribution limit is 100% of your self-employment compensation, dollar for dollar, up to the overall limit. So let's assume that you hadn't set up a solo 401k yet for 2024, but you do have self-employment income that you report for 2024. Let's assume that you maxed out contributions to a day job plan. Well, there's still time to set up a solo 401k and make employer and after-tax contributions. It's too late to make employee contributions for 2024 if your business is taxed as an S corp. If your business is taxed as a sole proprietorship, you can still set up a solo 401k and make employee contributions for 2024, but you'd have to make them by April 15th. But in your case, you wouldn't be able to make any employee contributions to the solo 401k if you already maxed out the employee contributions to the day job plan, because the employee contribution limited applies at the employee level. So you'd only be interested in making employer or after-tax contributions for 2024, which again, even if you hadn't set up a plan by the end of December 31st, 2024, you could still set one up now and make those 2024 contributions. You just have to set up the plan in time to make the contributions by the business tax return deadline, including any timely filed extension. So the advantage of the solo versus the SEP is that you're going to be able to make additional contributions as after-tax contributions. Let's assume that your self-employment income is $50,000 at W-2 wages from your self-employed business taxed as an S corp. Well, the employer contribution limit, as we know, is 25% of those W-2 wages, and that's it. But with our solo 401k plan, you wouldn't have to stop with making those employer contributions to 25% of the W-2 wages. You could make the difference up to those W-2 wages, since they're less than $69,000, $50,000 in this case, as a voluntary after-tax contribution. So 25% of $50,000 is $12,500. So you can make an additional $37,500 contribution as a voluntary after-tax contribution, and then move it over to a Roth solo 401k. So it's that with just that $50,000 of W-2 wages, you'd still be able to make another $50,000 in contributions to the plan. And it would not be reduced by the fact that you made those employee contributions to your day job 401k plan, because the employer limit to the solo 401k and the after-tax limit to the solo 401k applies at the plan level. It's not reduced by contributions made to a day job 401k plan. Hopefully that helps. Thank you so much for bringing the good question. When designating what amounts employee will contribute on their W-2 by January 31st, 2025 for 2024, along with the employer portion, is the business able to take a deduction for their employer contribution on the S corp return in 2024, even though the contributions will be made in 2025 for 2024? Great question. The answer is yes. So let's assume in this case that the plan was set up by December 31st, 2024. In other words, for example, you signed up with us by December 31st, 2024. That means that the individual preserved the ability to make all types of contributions for 2024, whether employee, employer, or voluntary after tax, all the way up until their business tax return deadline, including extension in 2025. So the employee contributions are going to be listed on the W-2. So it's not going to be on the employer's return. It's going to reduce, if it's a pre-tax employee contribution, it's going to reduce box 1 of the W-2. And so that's how the employee will get the benefit on their 1040, because less amount of income will be transferred from the W-2 to their 1040. Now, the employer contribution, that's reported on the employer's return. Let's assume the business is taxed as an S corp. So that's reported on the 1120S. So the contribution deadline for 2024 is the business tax return deadline, including extension. So March 17th or September 15th, for example, if the business is taxed as an S corp and they file a timely extension, then they'd be able to make those employer contributions for 2024 up until September 15th of 2025. So those contributions are going to be reported on the 2024 1120S and reduce the income that's reported by the employer, because that's an expense, right? Making contributions to the 401k for the employees of the business is an expense. It's a deductible expense. Great question. So please feel free to chat over more questions. I'm going to grab a link for that last question just to make it easy. We've got a tremendous pages on our website with deep information organized by how the business is taxed. So I'm going to chat over the link to the page on our website where we talk about S corporations. You can find the slides, you can find a video, find an infograph. So there's a lot of great ways to learn, to share the knowledge there. So yeah, please don't hesitate to chat over more questions. Please please subscribe. So we're going to be coming with a lot more prepared content in addition to having just the open office hour style session. For example, tomorrow we're going to be focused on solo 401ks versus SEP IRAs. So you can join tomorrow at 10 a.m. Pacific, 1 p.m. Eastern. You can join tomorrow at 1 p.m. Pacific, 4 p.m. Eastern. And then, of course, you can participate 24/7 on the forums, on our community, where it's always free to join. All are welcome. mysolo401k.net/my community. All right. Well, it looks like it takes us to the end for today. Oh, here we got another question. Wonderful. Can voluntary after-tax contributions be made if you restate a plan with you now that was established through Schwab's standard plan prior to 12/31/2024? Yes, because the plan was established by the end of December. I mean, even if it wasn't, because we're talking about voluntary after-tax contributions, you can still set up a new plan here in 2025 and make voluntary after-tax contributions for 2024. But because the plan was established by December 31st, 2024, that business has preserved the ability to make all types of contributions for 2024 by the business tax return deadline, including extension. So now the plan would just need to be upgraded to our plan. So now that it allows for those types of contributions, then the individual will just have to make those voluntary after-tax contributions for 2024 by the business tax return deadline, including extension here in 2025. So that's a great question. That's a classic scenario. All right. Well, until next time, thanks so much, everyone. We appreciate the participation. Oh, here we go. Another one made it in. Yeah, again, please don't hold back with the questions. More color regarding my first question. I'm an S Corp. I payroll myself $100,000 and the balance of my earnings is north of $500,000. My goal is to sock away $69,000 as a tax deferred contribution. I asked my accountant the question and he responded with, I'm not an expert in the area. Well, if the goal is to maximize the pre-tax contributions, the solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. Generally speaking, there's two buckets. One bucket is the employee bucket. The other bucket is the employer bucket, if we're talking about pre-tax contributions. Now, again, that employee contribution limit, for example, $23,000 for 2024, applies at the employee level. So there's no more employee contributions that could be contributed for 2024 if the person already maxed out contributions to their day job plan. But they could still make additional employer contributions, which are going to be limited to 25% of the W-2 wages, so $25,000. But then they'd have the benefit of being able to put more money in as Roth money by making a mega backdoor Roth contribution. Specifically, they can make a voluntary after-tax contribution of the difference. So that'd be another $44,000 if my math is right, 69 less 25, as a voluntary after-tax contribution. That would have to go into a separate voluntary after-tax solo 401k account before it gets moved over to the Roth solo 401k. So of that $100,000 of W-2 wages, they could justify $69,000 in contributions between the $25,000 employer contribution and the $44,000 voluntary after-tax contribution that gets moved over to the Roth solo 401k. Of course, that Roth contribution is not going to have any tax reduction benefit now, but you got all that potential for tax-free growth. Okay. Well, thanks so much again for the good participation. Until next time, take care.